Your car insurance just went up again. Not because you had an accident, not because you got a ticket. You didn't move to a different zip code or buy a new car. You did absolutely nothing different. And yet, the bill is higher. Maybe it's 20% more than last year, maybe 40. Some people are seeing their premiums double. When you call to ask why, the person on the phone gives you the same rehearsed answer everyone gets. Costs are up across the industry. Which sounds like an excuse until you realize it's actually true. There's a specific reason your insurance is more expensive now, and it has almost nothing to do with how you drive. Let's start with what insurance companies actually do. They collect premiums from millions of drivers. Most of those drivers never file a claim. A small percentage get into accidents, and the insurance company pays out. The difference between what they collect and what they pay out is profit. Simple enough. The whole system runs on one assumption, that the company can predict with reasonable accuracy how much they'll pay out each year. They hire actuaries to build models. Those models look at your age, your car, your driving record, where you live, how much you drive. They calculate your risk. They charge you a premium that covers your expected cost plus a margin. For decades, this worked. But something broke. The models started failing, not because drivers suddenly got worse, but because the costs of the accidents themselves changed in ways the models didn't anticipate. And that's where the math gets uncomfortable. Here's what happened to the cost of a car accident between 2020 and 2024. The average cost to repair a car after a collision increased by about 50%. Not 10%, not 20, 50. Why? Cars got complicated. That fender you just dented, it has a sensor in it. The bumper has a camera. The side mirror has a blind spot monitor. The windshield has a heads-up display embedded in the glass. Your car has more computing power than the spacecraft that landed on the moon, and all of it is fragile, expensive, and nearly impossible to fix. A decade ago, replacing a side mirror cost maybe $60. Now it can cost $800. Because it's not just a mirror anymore, it's a module. It has to be recalibrated. Sometimes it has to be programmed by the dealership because independent shops don't have access to the software. And that's just the parts. Labor costs are up too. There's a shortage of trained auto body technicians. The ones who are left can charge more. Repair times are longer, and while your car sits in the shop, the insurance company is paying for your rental. So a minor accident that used to cost $3,000 to resolve now costs $6,000. But it's not just repair costs. Medical claims are exploding. The average injury claim from a car accident has increased by about 30% in the last 4 years. Part of that is healthcare inflation, but part of it is something else. Litigation. More accidents are ending up in court. More people are hiring lawyers. The settlements are bigger. And even when the insurance company wins, the legal fees are enormous. There's an entire ecosystem of personal injury law firms that specialize in car accidents. They advertise constantly. You've seen the billboards. Hurt in a crash? Call us. They work on contingency, which means they only get paid if they win, so they push for the maximum payout. Insurance companies used to settle most claims quickly and quietly. Now they're facing lawsuits over accidents that 10 years ago would have been resolved with a phone call and a check. The system became adversarial, and that costs money. Now add one more thing: theft. Certain cars have become incredibly easy to steal. Kias and Hyundai specifically. A design flaw in their ignition system means you can steal one with a USB cable in about 30 seconds. This became a viral trend on TikTok. Suddenly, teenagers everywhere knew how to hotwire a Hyundai. Insurance companies started paying out theft claims at a rate they never anticipated. In some cities, if you own one of these cars, your insurance premium tripled. In others, companies just stopped insuring them altogether. Even if you don't own a Kia, you're paying for this, because insurance operates on a shared risk model. When costs go up for part of the pool, rates go up for everyone. So here's the uncomfortable part. Insurance companies aren't just raising your rates because they're greedy. They're raising them because they're losing money. In 2022, the auto insurance industry in the United States had a combined ratio of about 103. That means for every dollar they collected in premiums, they paid out $1.03 in claims and expenses. They operated at a loss. That's not sustainable. So they do what any business does when it's losing money. They raise prices. But there's a limit to how much they can raise them, because insurance is regulated. In many states, companies have to get approval before increasing rates. They have to submit their math to state insurance commissioners and prove the increases are justified, which means the whole system moves slowly. By the time a company gets approval to raise rates, costs have already gone up again. They're always behind, and customers are always angry because the price keeps climbing and nobody can explain it in a way that feels fair.